Very, very excited to have Nate on this call. I want to bring him on just to share some of the best practices that he's noticing as a lender, what would be beneficial for us as investors to grow our portfolio. At the end of the day, whatever we're doing, our goal is to, for most of us, is to build our rental portfolio. And that's what Nate helps a lot of other investors that we refer to him grow their rental property portfolios. Hi guys, my name is Sharad. I am the owner and founder of REsimpli. Very excited about this call. It's a very special call. We have Nate Mack from Huntington Bank on this call. He personally helped me with a mortgage on my personal residence. So very excited to have him on this call. We'll get started in a minute, but if you guys are able to, if you can have your camera on, that'll be great. This way, I can see all your guys' beautiful faces, makes the call more interactive. If you're able to, if you're not driving or anything, that would be great. Hey, Nate.
Hi, how are you?
I'm really good, man. Really good. Finally, really nice to meet you. We've talked so much on the phone, but so nice to meet you, man.
Absolutely. I'm excited to be here.
Yeah, super excited to have you on the call. So guys, I just want to say, I think I'd mentioned on a couple of these calls, I live up in Toronto. I'm moving to Carlsbad, California, north of San Diego area. I purchased a house last month, and it was probably one of the worst experiences I had working with Wells Fargo. It ended up costing me additional $50,000 working with Wells Fargo, and they just could not, the loan just would not go through the underwriting process. Then I was talking to my project manager, Claudia, who lives in California, and I asked her, I said, hey, I am having really hard time working with Wells Fargo. Their underwriting process super slow. With all the investors that we work with, who are they buying their properties with? And she said, oh, you got to talk to Nate. And I contacted Nate, and this was a week before the closing, and we hadn't even started the process. And Nate said, he looked at my information. He said, hey, we can get it done, but we need one additional week. So we had to extend the closing by 1 week. So he ended up helping me close that house, the loan, in 2 weeks, where Wells Fargo could not even get the underwriting done in 4 weeks. So I told Nate that I'm forever grateful to him. He helped me buy my primary residence that we absolutely love. It's in a perfect neighborhood, exactly the kind of house and neighborhood we wanted. Even the agent on the deal was shocked how quickly Nate was able to get done. And I kept calling him and texting. I would call him and text him every day. Hey, Nate, are we good? Are we good? Just because I couldn't believe when Wells Fargo could not even get the loan through underwriting in 4 weeks, that we could close from start to finish in 2 weeks, which was absolutely shocking to me. Even the agent on the deal mentioned that he's been in business for a number of years. He had never seen anything like that. And then I talked to my project manager, Claudia, and she said, so we had referred a lot of our investors, we sell a lot of properties turnkey to other investors. So we had referred a lot of our investor clients over to Nate, and everyone had nothing but great experience working with Nate. So very, very excited to have Nate on this call. I want to bring him on just to share some of the best practices that he's noticing, as a lender, what would be beneficial for us as investors to grow our portfolio. At the end of the day, whatever we're doing, our goal is to, for most of us, is to build our rental portfolio. And that's what Nate helps a lot of other investors that we refer to him grow their rental property portfolio. So with that, welcome, Nate. How are you, man?
I'm great. Like I said, excited to be here. I appreciate the warm introduction. And I really don't have to take up too much of your time. There are a few things I wanted to touch on, and I'm really curious to see if any of you have any questions for me that I might be able to help out with as well. Now, it's funny that you mentioned that story, because I wanted to start by talking about the role of a loan officer, the role that a loan officer should play, and why you have these, I always hear these stories of these types of discrepancies between experiences. And the reason is largely because I like to use this analogy that underwriters their role has changed dramatically since 2008 with the introduction of truth in lending laws and things of that nature. They are tasked with making absolutely sure that a borrower can qualify for a home and that we're not putting any undue financial pressures on them. And that's where your debt to income ratios and things like that come into play. Now, the underwriter is effectively the prosecuting attorney. They are there to find any perceived risk, any reason why a particular loan should not be approved or would be a risk to an institution. That puts your loan officer in the position of your defense attorney and going to have a public defender and be particularly familiar with the law, keeping with the analogy in that case. And that's where you sometimes have these hurdles. Like in Sharad's case, not something that could not be approved. But if you're not familiar with what you're looking at, or you're not understanding the underwriting guidelines and for instance, the way in which an underwriter might be calculating income, or a guideline that might have a loan referred for denial. If your loan officer doesn't understand that or know how to, for lack of a better term, combat that, a loan can be denied when it doesn't necessarily need to be. So it's really important that you work with a experienced, knowledgeable loan officer, because that can really be the difference between spending too much, making too little, things of that nature. A loan not closing, a loan being denied, so on and so forth. Now, I really feel strongly that there is value in partnering with the lender that you work well with. And a portion of that is because of these sorts of issues. You would want someone who is familiar with your finances, familiar with how your income is calculated. If you're doing multiple loans, you have X amount of deals a year, you do this year over year, you may, because you do not get to see necessarily your debt income calculation or what the underwriter perceived based on a particular document that was submitted, you won't see that. So often you won't know the reason why a particular loan was not processed quickly or not approved. A loan officer that you've worked with that is very familiar with your finances will be able to spot those things earlier on, because, I mean, for lack of a better way to put it, I know your financial life pretty well. I'm pretty familiar with it because we've gone through this process before. A partnership that way can help you help your loans to close quicker because of that familiarity. Maybe a process that may have taken 4 weeks can be done in 2 because we've gone through this. I'm familiar with your properties, the income calculation from that properties. We might have done another deal in this same calendar year. So we're using the same tax returns, things like that, that can help you to move quite a bit quicker. And that communication with your lender is also going to play a big factor in that. There are also strategic partnerships for those of you that may run businesses and sell homes. There are discounts that you can offer to purchasers for working with you. That also infers some credibility by having that partnership with an institution that has already earned a potential buyer's credibility. So that's something worth taking into account as well. Just how that is perceived, and being able to offer that really does speak well of any small business. Now, my goal as a lender is always to simplify. and that's keeping with the theme here. But that said, by working with and keeping that strong relationship with a particular lender, it does simplify the process. You have an open line of communication. Deals sometimes fall through, deals may not move forward. There are varying costs across these deals. For instance, many properties have what's popular within the industry with my institution and with others are property discounts to your closing costs. Now, this isn't wholly, a goodwill effort. My institution offers discounts to closing costs for properties in low and moderate income areas. So using census tract data, all areas are separated into 4 categories: low, moderate, middle, and upper. Lenders are judged on how they service low and moderate income areas where they operate. If you have a location within any particular county, you are judged on how you service low and moderate income areas. So it's in the lender's interest to incentivize business in those areas. And that's to your benefit because there are often closing cost discounts in those areas to incentivize those types of purchases. That's something that you may not see advertised, you may not otherwise know about, but that can have a significant, play a significant factor in the actual out-of-pocket costs that you would see. And you should communicate with your lender about that as you're considering a purchase. So you can take those things into account as well.
Michael has a question. Michael, do you want to explain a little bit on that question?
Yeah, you said lenders are judged on how they service their low and moderate. I'm just curious who's judging you guys. I mean, who are you talking about?
Federally.
FDS.
Yes. So, and this again goes to truth in lending. Many of those.
Is there like a certain division in the Fed that you're talking about? I'm just curious. I mean, it's obviously not a huge deal, but I'm just curious who handles that oversight, what departments you guys have to cater to, if you will.
No, to be honest, I couldn't tell you. I know the I know the guidelines. I don't know the oversight.
No worries. But I was just curious.
No, I appreciate the question. I only mention it to speak to the reasoning for these types of discounts. The difference can be significant for you. And so I only mention that to say it's worth exploring when you're considering a property with the lender that you've partnered with, if there are any discounts on a particular property, because you should take that into account in your decision making.
So would it be something, after I closed on my property with Nate, it's funny that I referred my friend over he's buying 2 or 3 multi-units from us, and I referred him to Nate. And this is the friend who had referred Wells Fargo to me. So it's interesting, kind of, he referred Wells Fargo to me. It didn't work out for me. And then I said, hey, I work with Nate. Nate Gaurav mentioned that you had brought up some sort of credits in the city where he's buying properties. Is that what you're referring to? Like he had no idea about that?
Yes.
Like some sort of, right? Like he had no idea. Like he owns about 35, 40 properties, but this was the first time he was hearing about some sort of like additional benefits he can get buying in the area where we're selling properties, right? He had like no idea. We've done like close to 1,000 deals. And this was the first time I heard about that he's able to qualify for some sort of credits.
The guidelines, or I should say the laws around this topic get kind of intricate. And I only mention that because they're very specific around targeted marketing in lending. And for that reason, you won't see as much advertisements around these types of discounts, because things can be skewed as predatory. Low people in low to moderate income areas can be a protected class in lending. So institutions are sensitive around that. Now, every institution has a legal department that advises, and those, they can be advised differently. But some of these discounts that are out there, you may not know about unless you ask. So it's really important to have an open line of communication with whatever lender that you choose to work with, so you know about these things as you go into a particular transaction.
So
now,
what sort of questions should we be asking lender to see if we as buyers qualify for some sort of discounts or credit in the area where we're buying property?
If you're reviewing a couple different properties, I would send those property addresses to your lender and ask for call. They can tell you, or at least I could tell you, particularly if there were any significant differences in the payment, cash to close, things of that nature. It's also to talk through loan to values. A lot of people don't realize that while, for example, a single family investment property, you could put down as little as 15%. You're going to have a hard time finding a company to give you a mortgage insurance policy if you only put down 15%. So let's set that aside. 20%, that's doable. No mortgage insurance, that is fine. You're going to see a significant difference in the points that you have to pay between 20 and 25%. So in most cases, if you have the capital to do it, 25% is going to be the way to go, because you're going to see probably 1 to 1.5 points less due at closing based on that loan to value. Now, your lender can calculate that. They can tell you exactly what you're in for. Maybe a property has some of those closing cost discounts, and that might offset the expense of those points. But you can explore those things before you go into contract, and maybe that affects your decision making, especially if you're weighing multiple properties.
Right. Another thing that I found out, which I didn't even know was possible, was because, so we had gone through the Wells Fargo process for my personal residence. We had already done an appraisal. Appraisal came in okay. And then we started working with Nate. I didn't even know. Nate said, hey, we can just transfer the appraisal over. You don't have to go through another appraisal process and spend, this money again, which I didn't even know. So like those sort of things, I think it's always worth asking your lender. Like in this case, I didn't even ask Nate. He mentioned it to me, hey, since you already had an appraisal done, we can just transfer it over from Wells Fargo. We need like a specific type of file that Wells Fargo needs, or whichever lender did your appraisal needs to send over. So it's in that specific format. And then we didn't even have to do another appraisal when we went through Nate. So Nate, what are some of the other questions that, or fees that you think an investor or buyer may not be negotiating right now, but they could negotiate with a lender, with some of the fees or other, costs and stuff that are incurred with the loan?
It's primarily those, because what is often not realized is that the lender fees are a small amount of your closing costs. The lender, typically it's around $1,000, $1,200. That's going to be the lender fees. Everything else is third party, from your appraisal to the company pulling your credit report and title is third party. That's what makes some of these these closing cost discount opportunities so valuable, because even when you might see an advertisement for no origination fee, origination fees are significantly less than, in most cases, than even title alone. So when a company does have the power to waive those origination fees, but a discount like this, a credit based on, I know some other companies do something similar, so it's not just Huntington, but a discount like this can have a greater impact on the cash that you're actually spending at the closing table.
So the question would be like, you could straight up send a property address to your lender and just ask, hey, does this property qualify for any sort of credits based on where the property is located?
Exactly, because the discount I'm referencing is entirely having to do with the property's location, not the loan type. It has nothing to do with the individual purchasing it or the property use, which is a big distinguishing factor, because many of the benefits out there don't apply to investors. But in this case, it's solely dependent on the location of the property, being in one of those low or moderate income tract areas. So definitely worth the conversation.
Yeah, I didn't even know that until my friend Gaurav, he mentioned it to me that you had brought up some sort of a discount because where the property is located. So that was super helpful. Wes, you had a question?
Yeah, thanks, Rod. Hey, sure. Nate, I've never heard of this before either, but is there a particular term that the property location criteria sits under? So for example, I have several lenders in my network. If I were to go to them and say, hey, do you have any additional discounts based on the property location? I can already see where a lot of my lenders will ask, like, what are you talking about? So I guess my question to you is there a particular phrase or language, term, kind of keyword that you would recommend using with lenders when we're having that conversation?
Yes, absolutely. And that's a good question. The way that I would phrase it is I would ask if you offer any discounts in low or moderate income areas, because that is what it's based on, and it's across values as well. I've seen this applied for $1 million homes that just happen to be. I live in the city of Columbus, and we have a lot of condominiums. So I know a particular area I did a loan for. The home was $900,000, but this little strip, this income tract, was drawn along a road, and the road was lined with condominiums. It's just census tract data. So it fell into a moderate income tract, and that individual saved probably some $5,000 on their closing costs for having been in that area. So these types of deals are across the board, and consider them attached to the property. You know, they're not attached to anything else but the property itself. So yes, I would certainly ask about low and moderate income tract areas, and if there are any particular discounts that might apply.
Cool, thank you. One more quick question. Did you mention there's a template or a form that you would recommend borrowers using when corresponding with specific lenders? Maybe it was you, Sharon, who mentioned that, just kind of specific criteria that you would input into a form. That way everything is kind of all spelled out when you're going through that. I call it like the qualification process, pre-underwriting.
Mm-hmm. Well, particularly, yes and no, particularly for your properties. If you have a good portfolio of residential properties, sending over a schedule of real estate owned can be really helpful for a lender. If you're working with a lender that you've partnered with over multiple deals, they should pretty well have that established. So not necessarily anything that you would need to bring to the table in any particular form or format, but your lender should be really doing the legwork for you on that side. I did want to talk a little bit about the way that rental income is underwritten, because I think that there are also some misconceptions about how lenders view that. Because lenders are not looking, if you've owned a property for more than a year, we're not looking at the lease agreement. We're looking at the tax return first. And I see some simple mistakes made on tax returns that actually lessen the amount of qualifying income that can be used. So on that topic, something that we could all be mindful of. A property's net income on your schedule E. So each property, we look at the net income, and there are certain things that we can add back to the cash flow of that property. Those things would be taxes, insurance, interest paid on mortgages, and depreciation. What is noticeably missing from that list is repairs. I often see people investing in their properties and putting large expenses under repairs. And there are some cases where they can be, if they're well documented, and they're types of repairs that would not be likely to recur. A client of mine, a home was hit by a car. We were able to document that. Some, $18,000 in repairs were added back to the cash flow for that particular property. But if without that documentation, it would not have been. Well, I was just referencing depreciation, and of course, I would, strongly suggest you all talk with your tax preparers about this particular issue. But depreciation is added back to your cash flow of any given property. And it's important that you claim that depreciation because, you claim the maximum depreciation that you can, because not only does it lower the tax liability that you have, you can add all of that back to your cash flow. And there is a recapture that can be done by the IRS when the property is sold. So if you have not maximized the depreciation that you could have claimed, you can sometimes leave money on the table. And now I'll leave your tax preparer to tell you more about that, but that's important for you to know. And that's important for you to ask your tax preparer about when you are having your taxes prepared and looking over that net income cash flow, because that is wholly what we lean on when we're assessing your income from your properties. The only cases where we use lease agreements is if a property was only recently acquired and the tax return would not accurately reflect the income generated from that property. Even in that case, the income from the lease agreement is lowered by 25%. And that's what's used to qualify, which is then offset by any mortgages on the property. Are there any questions about that?
No, I mean, I was going to say what you mentioned about like having well documented, a good documentation for expenses that you have on your tax return, because it happened with me. So when I submitted my tax return, I had some large expenses against my rental properties, but if they're like one-off expenses, then they get added back to qualify towards your loan. So that's very important to keep good documentation about the one-off expenses that you have. And Nate, if you can also, before we move forward, does anybody have any questions related to this? Nate, one other question I had was, I think it's also important for people on the call to know like the difference between a portfolio loan and loan that's going to be sold off. So can you just speak to that a little bit? Because the loan that I had was a portfolio loan, so where the lender has a little bit more control on the loan versus the one that is not a portfolio loan. Is that correct?
Absolutely. So portfolio loans, essentially, it's the lender going in their own pocket to lend to you directly, as opposed to conventional loan types through Fannie Mae, Freddie Mac, that have these third-party investors that purchase the loan essentially immediately after funding. That said, portfolio loans come into play in some specialty circumstances. So any jumbo loans are portfolio loans. That means loans above the conventional loan limit. There are also portfolio loans for non-warrantable condominiums. That's something that you will run into relatively often with condominiums that are attached to multi-use constructions or newly constructed that have not reached a certain occupancy level. So that can be really helpful. That's something that I see people bumping their heads with often. I often have people referred to me because of that. They went into contract not realizing that a property was non-warrantable, and now they cannot qualify for conventional financing. So that is a great tool. It's good to have a partnership with a lender that has a good amount of portfolio loan types that they can offer. Also, land purchases are typically would be a portfolio loan type. Conventional Fannie Mae, Freddie Mac, they don't really care for those things of that nature. ARMs you tend to see more of that on the portfolio. The rates are much higher with conventional loan types.
Yeah, because that's kind of what we happened like a couple of days before the closing, or like a few days before the closing. You said our loan got picked for what's it called, like RFA or something?
Pre-funding audit.
Pre-funding PFA. And I was like, oh shoot, we're like a few days away from closing. And then of all the things, like it's a very random thing where your loan gets picked up for an audit. But Nate mentioned that don't worry, even if something were to come back, it's a portfolio loan, so we can override that, but we didn't need to do that. Everything came back okay. But yeah, so it's really important to know, if you're working with the lender, if it's going to be a portfolio loan or if it's a loan that's going to be sold off to Freddie Mac or Fannie Mae. With a portfolio loan, the lenders have a little bit more influence on the loan versus the one that are being sold off to Freddie Mac or Fannie Mae.
And Sharad, I'd add something to that as well.
Sure.
It matters the institution's profit model. And what I mean by that is some institutions, especially these smaller shops, they write loans to sell. They do not plan to service these loans, and they are not built to service a large amount of loans. So you can almost count on your loan being sold typically in short order. And when I say sold, I mean not just the debt, which is what all institutions do with Fannie Mae, Freddie Mac, but selling the servicing. So that's when you get that letter in the mail that says you have a new mortgage company, off somewhere in Arizona.
Right.
That happens quite often with some of the smaller companies. When you partner with a larger institution, they tend to have a different profit model. I can speak for my own in saying that we view our mortgages not as a very large income generator. It actually is more so a lead generator in that it expands our customer base, because the likelihood statistically of you doing business with an institution is much higher when they hold your mortgage. So we have larger banks like this one and others have an interest in servicing those mortgages. So you're not going to see, while they still are an asset and conventional mortgages are saleable, that term is actually used synonymously with conventional and saleable. While there still are saleable mortgages and viewed as an asset that can be, sold if in case of a merger or things of that nature. It is not within the profit model, so it is not a company like this one's intention to sell your mortgage. So for that reason, you have a little bit more stability. I think a lot of times, someone finds a mortgage and it's an eighth of a point lower in the interest rate, and then they have just a terrible time with the company because the company never had that intention to service your loan. That's not what they were built to do.
I see. Yeah. No, that's very useful. Anybody else has any questions about, lending mortgages for Nate? One last question I'll have for you is with the way the market is right now, what are some of the things that you're noticing other successful investors doing, for building their portfolio? Like, what have you noticed that's worked for, based on your experience working with other investors, buying properties all over the country, to help build their rental property portfolio?
Just understanding the guidelines and limitations, or at least working with someone who does. I often see investors bumping their heads with this 10 property, the guidelines around 10 properties. You can have no more than 10 mortgage properties. Many don't realize that there's a credit score limitation that comes into play when you have more than 6. So that is even a number to keep in mind, because I've had people go into contract and they couldn't qualify for property number 7. So just understanding those things prior to taking the step of going under contract, having that relationship with a lender can be helpful. A tip about that 10 property rule that you should know is 10 properties, 10 mortgage properties. So you can have 12 properties if only 9 of them have mortgage. Also, spouses. This is kind of a nifty trick. Spouses. So, for instance, a husband and wife purchase a property together. Only one is on title, but both are on the mortgage. That individual that holds the mortgage but is not on title does not have to count that property. If that's the other way around, both parties are on title, but only one is on the mortgage, the individual who is not on the mortgage will have the entirety of that net income included in their income calculation, despite that property being mortgaged, because they do not hold that mortgage. So there are some ins and outs, some tricks when you get around, when you get higher in your portfolio. There are some tricks. It's helpful to work with someone who is familiar with working with investors to help you navigate that. That is usually when we begin to talk about consolidation, maybe consolidating a couple of properties together in order to free up another space, things of that nature. If there's one other thing on my list, one other tip that I wanted to mention that I just noticed that is not common knowledge, that is Form 1007 and 1025. When you are purchasing a property that is not currently rented, you can ask of the appraiser, or your lender can, to order to fill out a Form 1007 for single family properties, or 1025 for multifamilies, and they will do a fair rental calculation, and that can be used in your qualification, essentially including rental income from a property that is not yet rented. That can be make or break for some people in their debt to income ratios. And if it's something worth mentioning to your lender, if your lender has not mentioned it to you. That's the only other thing on my list. But if you have any questions, I would love to help.
Yeah, Nate, if you can also, we'll send your contact information out to our email list. But what's the best way? Like, is it email? Is it, call? Like, what's the best way for someone to get in touch with you?
Oh, email, of course. But I will include my cell phone number. You're welcome to text or call me directly, especially if it's time sensitive around purchases, things of that nature. I want to make sure I don't keep you waiting. So feel free to give me a call. Any emailed inquiries will always be addressed within 24 hours.
Yeah, and guys, I can say from my personal experience, Nate was absolutely amazing to work with. I've already referred a couple of other investors who work with Nate, and they're closing on some properties, I think this month or next month. And I'll drop Nate's information right here in the chat. And then we'll also email this out to everyone. If you guys have any, question, definitely reach out to Nate about that. Any other questions, guys, before we let Nate go? I want to respect his time.
Hey, Sherrod, this is Jeremy. Quick question.
Hey, Jeremy.
Hey, I jumped in a couple minutes late.
Sure.
What area, Nate, what markets are you? Are you pretty much in every market, or is it particular markets? I don't know if I heard that part.
No, I'm actually glad you asked, because I didn't mention that. I lend in all 50 states. Also, one of the benefits of sometimes working with larger companies is that you do have those licenses. So yes, I can lend all over the country.
Awesome.
Yeah,
And
so all our investors that are buying turnkey properties from us, we definitely put them in touch with Nate. And even though Nate is based in Ohio, the property that I purchased for my personal residence, before I was staying in California, Nate helped me with that without any issues.
okay.
Yeah, just for a little bit more context, for the majority of my career, I've worked as a national lender. So I'm actually familiar with some of the more nuanced laws in really across the country, transfer fees and that are higher than average in maybe Florida or Pennsylvania, little things like that. So it is helpful. Again, it's all about who you're working with and your comfort level. Not necessarily myself, but whoever you decide to work with, it's in your best interest to make sure that they are knowledgeable. And once you have established a strong relationship with them, continue to work with them because it will make your life a little easier. And I know REsimpli is all about simplifying this process for you all. And that's just another way to do it.
Cool. Appreciate that.
Absolutely. Gerard, I really appreciate you having me.
Yeah, thank you, Nate. Yeah, no, I mean, once as we were getting closer to the loan process, I reached out to Nate and I told him, I said, Nate, you would be great to come on this call. And then we're also going to be launching, on our website, like a list of preferred vendors. I'd love to kind of put you on that, just so that like companies that we've worked with or, referred to us, or companies that we've had great experience with, they definitely want to make sure we add value to other investors. Because like I had amazing experience working with you, and I know other investors, my friends that I've referred over, other investors that were selling turnkey properties to, everyone has had nothing but great things to say about you and just working with you. They've been able to close loans on time and, save money, like some of the things they didn't even know about, like the property that Gaurav, there's a couple of properties that he's buying. He didn't even know about that. And then, you were able to educate him on that, but he's going to save some money on closing costs. So that was, he was super excited about that.
Yes, I'm a better lender than a public speaker.
No, you're great. And I love like how you're always very calm. I would call you, text you, I'm like, hey, Nate, what's going on? Are we going to close on time? Because we have a tight deadline. Nate's like, yeah, don't worry. Everything is under control. So I appreciated that.
Absolutely. Absolutely. My pleasure.
Yeah. All right, Nate, I put your information in the chat. We're also going to email it out to our email list and, let them know. And then this recording will be available on our Facebook group and we'll put it on our YouTube channel also. So again, I want to thank you so much for personally helping me close on my home and then coming on this call and answering some of the questions and just educating, our users a little bit about the mortgage process.
My pleasure. Thank you again.
Cool.
You have a good one.
Thank you. All right, cool.
Bye.
Thank you guys, everyone, for jumping on the call. I appreciate it. And I'll see you guys next week on the call. Thank you so much. Have a great rest of the week. Thank you.